Hold on, I lost my notes. There we are.
Okay. I was like, you paused. I'm like, did my screen freeze or he
No,
just
here we are.
paused?
Welcome to the Source of Commercial Real Estate, where we discuss all things commercial real estate. I am your host, Jonathan Hayek, and today I am talking with Sandhya Seshadri. While working in corporate, Sandhya saw firsthand how people dedicate so much of themselves to work while simultaneously missing out on crucial opportunities to protect and grow their wealth. That's why she loves spreading knowledge about the power of passive investments in real estate. Sandhya owns over 1,400 doors as a general partner and is a limited partner in 26 deals. Sandhya, how are you today?
Doing great. Thank you so much for the opportunity, Jonathan, to be on your podcast and add value to you and your listeners.
Of course, my outline is much longer than we've got time for today. I am really looking forward to this conversation. So, why don't we just get right into it? Sandhya, tell me about your background, how you got started in real estate, and what your work looks like today.
So I started in real estate because I was looking for tax savings. So back in the day, like most Asian geeks, I got an engineering degree, got a job in a high tech company, realized quickly that business folks are making a lot of the decisions and telling technical folks what to do. So I wanted to understand that process, got a part time MBA, thankfully paid by my company. Got into the stock market quite a bit heavily with investor clubs, etc. And then was looking for a way to save on taxes because we were, double income and making good money with stocks, etc. And I did not have a handy person background to do flips or single family rentals. The thought scared me, and the margins didn't seem to be worth the trouble or the headaches associated with it. So when I learned about large multifamily syndications, where I'm more of an asset manager, because I used to do project management at work as well, it was a very good fit because we would employ a third party property management to do all the day to day leasing, all the repairs, maintenance, etc. So asset management really made sense. And Dallas is where I live now. I've lived here for 32 years. Seems to be an excellent market for multifamily. And so I've been doing this for a little over 4 years now. And because of my ability to know the market from living here for a long time and knowing my neighborhoods, that's sort of my secret sauce is my extreme micro knowledge of the market. And of course, with engineering, underwriting is easy. And I started out as boots on the ground by partnering with experienced syndicators before I became a lead myself.
Awesome background. Thank you for sharing all that. I want to get into the market in
Mhm.
which you invest. You touched on it. You're investing in DFW. You live there, and quite honestly, I mean, there you'd be hard pressed to find a hotter real estate market, especially in the multifamily world, than
Mhm.
DFW right now.
Mhm.
I just hear about lots of large private equity firms are
Mhm.
heading to DFW. There's
Mhm.
a lot of opportunity there. There's a
Mhm.
lot of ground up going on in DFW.
Mhm.
So tell me about your reasoning for continuing to invest in DFW. Some people would say it may be too competitive, it's too overheated. Go elsewhere where there isn't so much competition. So walk me through your thought process of continuing to want to invest in DFW.
So, having done 8 syndications now in DFW, I am known to the brokers, so I will have that slight edge. I'm also part of a larger mentoring program, which also has the edge in terms of getting the deals awarded. And because I have current properties and I know like literally thousands syndicators with properties in the Dallas area, I probably know someone who operates a property nearby, the subject property, if I'm looking at a deal. And so I can do a more thorough analysis of the comps, which is the rents and other income and all the other basic homework you would want to do when underwriting a deal. And I can do it slightly better because of my connections, my network, and knowledge of the market. The biggest reason for DFW as a market is the usual, which is your population growth, job growth, diversity of jobs. Those are very, very crucial things. I also obviously within that submarket look for places which have high median household income and low poverty levels, low crime. So I know my little pockets of great locations to invest. So we've got properties, for example, in Irving, 2 properties in Irving, in Carrollton, in Garland, just major metros that we know within the DFW Metroplex to invest in. The other reason for investing is, yes, there's a lot of new construction going up, but that's only going to affect your class A, which is the newer builds, right? Any apartments built in the last 5 to 10 years, we would call them as class A. And so they might face some competition from the new construction coming up. But class B and class C, which is built in the 80s and older, you can't have more of them built. And so if they're located in the right place, there's going to be workforce housing people with median incomes of like 50K to 60K kind of range who just cannot afford these class A properties. So there's always going to be a demand for them. So for every, white collar job, you're going to have at least 5 to 10 blue collar jobs to support it. And we are providing affordable housing for that market. So class B and class C will always be in demand. And we saw that through COVID in DFW. The Class C property that I managed was 1960s flat roof, etc. And we literally had to evict only one tenant at the end of all of that COVID and all the restrictions they had. So it was a huge investment opportunity, and investors did very, very well beyond projections. One, due to the cap rate compression, of course, that we all benefited, but also because DFW has a great market. That property was almost always 95% plus occupied, with most tenants paying rent.
I want to talk about your competitive advantage. I think this
Mm-hmm.
is really important for investors to figure out
Mm-hmm.
what their competitive advantage is, even if they're choosing to invest in a hot market like DFW or Charlotte or Raleigh or Tampa
Mm-hmm.
or wherever it
Mm-hmm.
is. You touched on a couple really important things. So first, I want to talk to you about. Do you think it's important for someone to invest in their hometown? I think it's common for people to say, "Oh, my hometown, there aren't any deals in my
Mm-hmm.
hometown. The grass is always greener." They always want to go elsewhere.
Mm-hmm.
Do you think people should make the extra effort to invest in their hometown?
Only if it makes sense. You got to have a landlord friendly area. So if you're sitting in California, I mean, I know some people who are very successful there, but I'm not as familiar with the rental laws or the sources of, say, rent relief programs, etc. So that would be unknown to me. So I would have to partner with somebody local. So no, you do not have to invest in your own backyard, but you do have to partner with someone who has that local knowledge to give you the competitive advantage and who can frequently visit the property. I mean, if every time you have to hop on a plane and fly out for 3, 4 hours to visit your properties, you're going to visit it less frequently. And so property management companies, if you use third party, may take advantage of that fact that you're not going to be doing surprise visits. And no matter how much you look at metrics, it's different from actually driving the property.
And so let's get into that. So you are local to DFW.
Mm-hmm.
You talked about being able to get deals because of broker relationships
Mm-hmm.
and your mentoring program.
Mm-hmm.
So I'm not sure what the question is, but I want you to talk more about having these competitive advantages that someone from New York or California who sees a hot market in Dallas doesn't have because they're not local.
I think if you're very well established and known to be doing great syndications, but in a different market, and you want to get into a new market, you want to definitely have your local brokers introduce you to the local brokers in the market you want to get into. And then you want to meet in person with them and build that relationship. Because in markets like DFW, the brokers really bring the deals. There's very few of off market. Okay, I'm going to write 100 letters to all these owners and get them to sell it to me. Because I have properties that are 100 doors plus, and the broker who awarded the deal to me is the one through whom I'm going to sell it. It's kind of one of those unwritten agreements that we do in most cases. So I'm not going to sell it to a friend, even if the friend comes to me with the offer that I need. Right. So that's just the way it goes. So you need brokers in competitive markets like DFWs. And the competitive edge that I have is there are 4 brokers living in my neighborhood. Literally, I could walk to their houses. I don't even have to drive to their houses. Right. And they know that I have closed deals on time, some in less than 60 days, etc. So the biggest thing a seller wants to know is your certainty of closure. So if you're a brand new syndicator trying to do your first deal, have the name of somebody else in your offer letter, which includes a history of their closed deals. That gives you a competitive edge. The other thing is knowledge of the market, right? If you don't have it, have a friend, a cousin, somebody who lives in that local market. Really scout the properties. travel there on a weekend, get a feel for what a property or a location is by day and by night. So for me, a lot of times when I run errands in general as part of life, I would pass by some of my properties. So it's not like an extra huge effort for me to visit my properties. Every one of them is within a 30-minute drive of my house. So that's my competitive advantage. So I can drive by it at night. We would go out to dinner and we just drive by and say, so what's happening on a Saturday night over here? Are there a lot of teens and, trouble going on, or is it like pretty reasonable? What's the landscape look like at night? Do I feel safe getting down and walking around? That's one of my little checks for a property is I'll literally park by the property at night and see if I don't feel safe there, then I'm not going to buy that subject property.
You talked about your relationships with brokers, and one of the key things that brokers and sellers are looking for is the certainty to close.
Mm-hmm.
I hear this phrase,
Mm-hmm.
broker relationships, thrown around a lot. What does that mean to you? Are you sending brokers gift baskets, and are you calling them every week? What does broker relationship mean to you?
So a lot of people get into golf and other ways to network with brokers. Fortunately for me, a lot of the brokers live as my neighbors, so I already know them or their spouses. So that part was easy. As far as networking with brokers, I still talk shop all the time. So I love to talk about deals. I love to discuss my deals, neighboring deals, any deals they have in the market. And so if I am actively today looking for a deal, yes, I will be talking to them on a weekly basis, if not more often than that. But at other times, right, if I just acquired a deal and then I don't need another deal for a couple of months, then it's more of I attend their happy hours or events and just keep tabs on what's going on. Or we'll see each other at common networking events in the area, which I attend anyway. So I probably should, but I usually just buy lunch or something. I haven't actually sent any special gift baskets just yet. But that's a great idea.
Talk to a beginning syndicator who understands that the deals are with these brokers, but maybe doesn't have much of a track record. What advice can you give a new syndicator to get the attention of brokers and start to get some deal flow?
I think you can sign up to get deals from any of the major brokerage websites. So that's easy. You can just get on the mailing list of Marcus and Millichap and Northmark and every major brokerage, say in the Dallas area. That's the easy part. The question is who will give you their time to explain the little nuances of the deal and take you on a property tour, etc. When I started out, I used the clout of my mentoring program or the resume of an experienced sponsor to get that foot in the door. So those would be
Let,
the two ways. Yes.
let's talk about your mentoring program. I think I've seen that you're a member of the Sumrock
Hmm.
Mastermind.
Correct.
Explain how being a member of your mastermind has helped you in your real estate investing.
So the first time I set up a property tour with a broker on a property listed for sale, I mentioned that I'm part of the Sumrock group, and I immediately got like serious respect. When he toured it, he took me seriously because again, that group has a history of closing. The group is already mentored and trained on the process. We have an ecosystem and support network of, the famous syndication lawyers, lenders like Old Capital, et cetera, Bellwether, and so on. So we already have the support system. We're not figuring out how to do a large syndication versus somebody might have just done a duplex or a quadplex and then goes to a broker and says, take me seriously. That's the difference is you have the name recognition, whether it's, a mentoring group, which has closed a lot of deals in that market is going to have that.
There's no shortage of gurus and
Mhm.
people out there trying to make money
Mhm.
in the multifamily world, whether it's through masterminds, coaching programs. They're
Mhm.
seemingly everywhere.
Mhm.
What key factors should an investor considering a mastermind? What should they be looking for in a mastermind program?
The easiest thing is to write out your SMART goals: specific, measurable, attainable, realistic, and time sensitive. So mine was within 12 months, I must syndicate one large apartment complex of at least 80 doors in which I participate actively in asset management. That was my goal because That's what my accountant said, is for me to be a qualified real estate professional, I have to actively participate in the asset management types of activities. And so that was my SMART goal. So once you write out such a SMART goal, you could write the dollar amount for the property, number of doors, whatever makes sense to you, and then speak to people from that program, whichever you're considering shopping, and say, is this realistic? Have you achieved it? What did you have to do to achieve it, right? A lot of people want think that they can pay these high fees, 20K, 30K, 50K, whatever, and therefore achieve their results. And it's like, that's just your entry into the country club, if you will. It's up to you to go network and make things happen. So what do you have to offer? Do you have time? If you have a really busy W-2 job or other things you are managing, are you going to have the time to invest into this? So be realistic about the time and capital. Anybody and everybody is going to need capital. It doesn't matter which mentoring program you join and which deal you want to get into. Capital is always going to be needed. So always say, don't shy away from that. Don't be in denial saying, oh, I'm the local boots on the ground. I know this market and I'm an engineer. I can underwrite. I don't have to raise capital. Everybody in the team has to raise capital. Cost of capital has gone up significantly. So regardless of which program you join and how much of a deal finder you are, if you want a good slice of the general partnership share, don't shy away from raising capital. Learn how to raise capital, read the books, listen to the free podcasts, etc. Make it part of your life.
A lot of people get into real estate by going to Podcast University and getting on the Bigger Pockets forums and bootstrapping it. Is it possible, and they've had success that way, is it possible for someone to bootstrap their way and go to Podcast University to do bigger multifamily, or let's say even non-residential stuff, $10 million plus deals? Is it possible to have success in that field without getting involved with a larger mastermind or mentoring group?
Absolutely. It depends on your background, right? If you've already been doing fix and flips, or you have family members who've done construction, etc., you have a strong real estate background to start with, your path will be much faster than, say, someone like me who had no real estate background and wanted to get in. So I wanted to have results quickly because that's how I get motivated. So I paid the fee to get into a mentoring program. So I'm surrounded by such people. It's the who, not how. Do you have to pay to have a who? No. If you find the right uncle, or if you're willing to, provide sweat equity, whatever else, it's a matter of who's going to help you. How do you convince a experienced person, sponsor, experienced construction person, etc., to help you get started, right? Or are you going to learn it the hard way, which could take you longer, but you can certainly do it yourself. And especially when you're slowly starting out with, single family, duplex, quadplex, etc., into bigger multifamily, most of the time you're only risking your own money, versus in all these large syndications, you're risking other people's money. And that's why it's important to have partners.
Love that answer. Sandhya, I want to transition into passive investing. You are an LP in more than 24 deals, and I'd love to get your thoughts on the state of the passive investing real estate market at this moment. We're talking in early April 2023, and there is a lot of people are talking doom and gloom. In your dozens of passive investments, what patterns are you seeing? Just kind of give us a 30,000-foot view. What patterns are you seeing in your investments right now?
The biggest patterns I'm seeing is that the deals on fixed rate interest loans are definitely doing better than the ones on floating rate loans. Especially, I don't have anyone that didn't purchase a rate cap, but I've heard of those. So if you have a floating rate loan and you don't have a rate cap, those deals are doing poorly, and because they are affected by the increase in interest rates. Otherwise, the fixed rate deals that I'm in, like the one I just sold, they did fine. They had no problem meeting their projections or making distributions, etc. 2 of the deals I acquired last year are fixed rate loans, so we are able to make distributions. So on a passive landscape, your biggest thing is always going to be first the operators and their experience in that local market, followed by your deal analysis. So if the operators know what you're doing, then you get into the metrics of the deal. And the biggest one is what kind of term sheet they have, right? What kind of a lending environment did they sign up for? And what are the risks associated with that? Are their rent assumptions realistic? And one of the fundamental questions I ask any general partner is, Show me the data from a neutral source that supports every input in your analyzer spreadsheet. So if you are assuming rent bumps of, I don't know, $200, did the property management company who's going to manage for you agree to that number? If you think that doing these fancy upgrades and granite countertops in a C-class property with a median income of $40K, they're going to have a $200 rent bump, show me the property management company who agreed to it. Show me a competitive analysis nearby that is a similar like property. That's one of the questions I ask. If you're assuming a certain number for your loan and it's a floating rate loan, I'm telling you, your proceeds could change the week before you close. So that's a big risk, right? Because based on what happens with the interest rates, that number can change. Your rate cap, you need a rate cap, but even then, they could ask you for interest cap reserves when it's even a Freddie floater a year ahead of time. So that's a risk. Your expenses, depending on where your market is. This is why your market knowledge is important, because taxes make a huge difference in a place like Texas, but in Atlanta or Phoenix, it's not a big deal at all, right? And similarly, if you have physically looked and driven the property, then you know, is there a creek behind it? Or is some parts of that building in the floodplain? How many such buildings in this, 200-door property? Because that's going to change your insurance. What loss claims have they made? So every little item in that input on that spreadsheet has to be justified and come from a neutral third party. And if you didn't do that and you're making assumptions because, oh, I felt like it, let me increase this number a little bit, let me tweak this expense a little bit, and that way I can show you double returns and, 18% IRR or something. But where did those inputs come from? That's the question to ask.
When you're asking operators these questions, how much grace and leeway do you give them? I'm thinking somebody like you who has a ton of experience and who has been in the trenches and knows some of these things that can come up that novice operators aren't thinking about. Maybe they don't have an answer initially for some of these questions. How much grace do you give them? Or is it just an immediate red flag? If they haven't thought about these things, and there's no chance I'm investing with them.
Well, I'll say, who's helping you? Who's your coach or mentor? Go back and re-underwrite and present it to me again with data that backs every one of your inputs, and I might consider it, right? But if you don't have any coach or mentor and this is your first deal, do I really want to be your scapegoat? In a way, I look at it as brain surgery. If today is going to be your first time being a brain surgeon, hopefully there's an experienced surgeon right there in the operating room with you. And I don't know that I want to be your first case. This is 50K or more of my passive money, and that's a large amount of money for me.
Yeah, great answer. Are you seeing in your passive investments distributions that have been stopped or delayed, things that are not going according to plan?
Oh yeah, plenty, right? Taxes, insurance, and mortgage have gone up significantly on a lot of deals. Even the fixed rate interest deals, taxes and insurance have hit them, or some disaster happens, etc. So I have seen it. And what I look for is the transparency of communications from operators and telling me what is their plan to fix this, right? So today, this is the state. Okay, I can see that you incurred a big problem and had to, you had a fire damage unit. You went ahead and spent the money to repair it. Now you're waiting for insurance money, etc. Whatever that story is, I want to know what is your path to fixing the problem. I don't want you to pretend like the problem will go away and just tell me, it's going to be fine. We're working on it. Okay, show me how. That's what I look for. And I still trust operators who have stopped distributions if they have a clear plan to tell me. And in some cases, the plan might be, well, we have enough to get through this year, and we're hoping in 2024 to refi or sell. And that's a fair answer, right? That's the case in some deals.
You touched on it a little bit. What mistakes are operators making right now, do you believe?
Not scrutinizing expenses enough, not tightening the budget enough, trusting the property management company is one example, or not recognizing how big a problem they have right now. If you are in negative cash flow today or barely breaking even, it's only going to get worse. And so you need to address that. You need to do the break even analysis. If you're in negative cash flow, figure out how soon you're going to run out of money. Don't do a capital call. Make sure you tried every other option because there's a lot of equity sitting in the sidelines. There could be some rescue capital coming in. You might have to give up some of your GP shares, etc., right? But go explore those options. See what you have to do to rescue the deal. Get a broker opinion of value, get a refi quote from a lender, and they'll give you targets. They'll be like, okay, you just need to improve your rental income by 10K per month, and then you can get this much in proceeds. That'll get you, your head above water. So whatever that is, go have those conversations now.
I think that's a really interesting insight of, I think there are some operators that may be proceeding with their head in the sand a little bit.
Mm-hmm.
I don't know if you were at the Best Ever conference,
Mm-hmm.
but
Oh, yeah.
the mood and the tone there was a little dark,
Mm-hmm.
from some of the speakers.
Mm-hmm.
Some of the speakers projecting, that there's gonna be some blood coming. And it's
Yes.
interesting talking with then operators. Operators are not, understandably so, they're not real eager to admit when they might be having trouble with deals. And so I think it'll be really interesting as we get towards the end of 2023.
Mm-hmm.
I'm thinking about Neil Bawa's uh,
Yes.
keynote,
Mm-hmm.
where he encouraged people to get help
Mm-hmm.
sooner
Mm-hmm.
rather than waiting and waiting and waiting and putting your troubles off, thinking things are magically going to get better.
No.
I'm thinking about, somebody, here we are in April, maybe they have a rate cap that's expiring in October or November, but they're not doing anything about it right now. And they're saying, oh, we've got 6 months, we'll
Mm-mm.
figure it out. And that is, that would be a huge concern to me if people are not real with themselves about, the status of their deal.
That's a big concern. You need 6 months prior to the expiry of your rate cap. A lot of bridge lenders, if you ask around, they are known for historically, even when the times were good, for not really extending these loans. So you've got to have a plan to either refi or sell. And that's why I said, get your target from your lender broker for refi. What does your net rental income need to be per month, as an example? And same BOV from a broker, which says, oh, I need you to have this much in NOI and this much upside potential for the next buyer to sell it at this price. And at 6 months prior to your rate cap expiry, you should be listing the deal for sale, or you should be doing your paperwork for the refi, because it takes time. Once you list it, tours come, then this offer comes. What if the buyer is not able to close on time, right? So that's too much of a risk. So at 6 months prior to expiry of your rate cap, you must have the deal listed for sale or working on a refi.
Sandhya, a lot of the context that we've been discussing has been in the multifamily world, but
Mhm.
you passively invest in more than 2 dozen deals. Do you only invest in multifamily, or do you invest in any other asset classes?
I've also done self-storage. So that's the other asset class, and it's doing fine. I've invested in two self-storage deals, and both have completed a full cycle and exceeded the initial projections, etc. Like double my money in less than 3 years, kind of thing. So I really like that asset class too. I just haven't explored it enough to be a general partner myself, and just stuck with multifamily for now.
Sandhya, I want to transition into personal branding and online presence. You do a great job, particularly on LinkedIn. That's where I'm the most active, of adding value to the world. It is a rare thing for people on the internet to actually add value. And I think you do a really great job at it. So, can you walk me through your strategy of your online presence? What are you trying to do online?
I'm trying to increase the awareness of multiple investment options to everybody, because all I knew for a very long time was a traditional path, which is stock market or buy my single family rental down the street. I didn't think I could participate in real estate passively. So one is educating on that, but also on the risks of doing that, right? So what things must you ask? Just like some of the questions I mentioned earlier. The second one is, now that I'm a syndicator and I have so many investors across so many deals, and I'm also a passive investor, what are some questions I get asked? What are some topics people want to be educated more about? Like, what the heck is a rate cap? A lot of people don't know that. Or, what's a prepayment penalty when it comes to yield maintenance, right? And you underwrite a deal, most operators don't account for that. They take a 10-year Fannie Mae loan on yield maintenance, but they plan to sell it in 5 years or less. Well, what's that yield maintenance look like? Because your IO period has probably ended, but you didn't account for it. Your buyer is probably not going to assume your loan without the IO, but nobody accounts for that. It's like, so all the little details, every time I get a question from an investor, it becomes the topic for my next post. And it's that easy. So just imagine you are speaking to that one investor and write your entire post.
There's a lot of icky stuff on LinkedIn. That's a
Mm-hmm.
technical term,
Mm-hmm.
where I think operators or investors feel like every single post has to
Mm-hmm.
lead back to asking people to invest with them.
Mm-hmm.
And it just doesn't leave me as kind of a bystander with a
Mm-hmm.
very good feeling about that person.
Mm-hmm.
It seems like in your posts and what you're trying to do online, you're
Mm-hmm.
also very active in conferences, doing lots of
Mm-hmm.
keynotes and speaking on panels
Mm-hmm.
and webinars
Mm-hmm.
and things like that. It seems like you are a value first kind of person. You talked about
Mm-hmm.
educating and talking about risks and what did one passive investor ask me? Okay, I'm sure other people are going to have this question
Mm-hmm.
too. So delivering value and
Mm-hmm.
educating.
Mm-hmm.
I've seen very few, if any, of your posts come back to, "Hey, invest with me."
Mm-hmm.
Is that purposeful, or can you talk about your kind of your philosophy there?
Well, the thing is, we're not selling Girl Scout cookies or Boy Scout popcorn. This is a 50K minimum kind of investment. So that's something that people have to get to know you, like you, trust you, and make a decision over a period of time in most typical cases for my investors. Now, we're not talking about the 500,000 check writer who just wants depreciation, right? We're talking about the typical investor who's my W 2 engineer looking for an investment opportunity. So they've got to get to know you. And for me, a platform like LinkedIn allows me to share my knowledge with a large number of people. And if they want to, they know how to DM me. In some cases, I've started adding on a few posts a little footnote to say, hey, if you DM me, if you want a checklist of questions to ask a sponsor, etc. And if they want to, that draws them to my website. And then if they want to connect with me, that's up to them. But chasing after people and doing pushy sales pitch, how many times have you invested? Because somebody had a great post that talks about, I don't know, multifamily and said, invest with me. I have the greatest deal. You're going to miss out on the opportunity of a lifetime, right? How do you want to be pitched? Do it the same way. You want to be educated. You want to be allowed to make your own decision. You want to do your own scrutiny and then decide if it's right for you. So I've had a friend who watched me do my first full cycle and didn't invest with me at all. And she's known me for 20 years. And she heard about this investment from another friend also in my neighborhood and then said, oh man, now I'm sold. Put me in your next deal. And that's how it happens. You got to allow people. Some people can decide overnight, and some people need 2 years to decide, no matter how long they've known you. And you've got to allow people the time they need. And it's about relationships. And some people will come to you saying, I have no money. Can you still give me 15 minutes of your time? I'll be like, yeah, I'm going to be driving to a property. I'll talk to you while I'm driving. I'm not going to sit in a Zoom call for an hour. And what happens is once they learn from you, they refer people to you. So never underestimate the power of a so-called person without money today and what they could be or do for you in the future. Just help everybody and automatically. It's like the Go Giver book. If you've ever not read it, go read that book. Keep helping people and the rest will happen.
I love that philosophy. It's just about, yeah, it's about relationships. It's about nurturing, because that one
Mhm.
time that you do that one LinkedIn post, the chances of somebody wanting to invest 50K at that one moment, probably not very good. But I know I've invested with people that I've been following for years. And
Mhm.
then eventually the time is right to
Mhm.
invest.
Mhm.
But it wasn't that one particular LinkedIn
Mhm.
post
Yeah.
or Instagram video that did it. It was
Mhm.
consistency over time. So I really love that philosophy. Inspire a new investor, maybe somebody that's new to LinkedIn. They understand the importance of having a social media presence, of trying to add value, of putting yourself out there, but maybe they feel like they don't have a lot of value to give, or what am I going to say? How does somebody start their online presence?
I would say figure out who you are trying to attract, how you are going to help them. What do people typically come to you for? So a lot of people come to me nowadays because their deals are in trouble and they want me to rescue them or give them ideas on where they can cut costs or find equity, etc. Right? So I'm a connector in some of them. I'm a strong operator in some of them, right? So that's how I help the existing syndicator. Why do passive investors come to me? They ask me, can I invest in the deal? I'm like, I can't give you that kind of advice, but here's 10 questions you can ask them. So figure out why people come to you, who you want to help, and target your messages like you're speaking to that one individual. And it'll be useful for all of the others, similar to that individual.
As we're all trying to raise money, I want to transition over to kind of the capital raising and talk for a minute or two about capital raising.
Mhm.
Um, what what kinds of questions are LPs asking right now? There are lots of media headlines about doom and gloom about commercial real estate. Are LPs behaving differently now than they were 2 years ago?
Absolutely. A lot of my existing LPs are sitting in the sidelines. And so when I did a survey to ask them, are you ready to jump in on a deal now or not yet? And they're like, most of them said, no, I just want to wait because I'm getting capital calls on some of my deals. So I want to preserve my cash and I don't feel safe in this environment to invest. So that's feedback I got from a lot of LPs. And then I have new leads who all want to invest. They're like, when is your next deal coming? I'm like, well, when the deal is right, I will have a deal. And if it's not right, I may not have a deal for another 6 months. Everything has to pencil in. I'm not taking chances on things looking better in a year's time. In fact, I'm planning for things to be worse because you really feel the impact of an interest rate hike, the full impact only 6 to 9 months later. You don't feel it's the same instant that it happens. So we don't know how much more blood is going to be on the streets later. So it's got to be the right. The other question I get frequently asked is, oh, this deal doesn't look like it's doing well. What should I do? I said, write out your questions and send a letter to the operators and ask them what they are doing to fix the situation. When do they run out of money? That's a fair question to ask because then the next step when they run out of money is a surprise capital call and you want to avoid that. So make sure you ask questions frequently and read your financials. Don't ignore them just because like I'm passive in at least 20 deals right now and there's a lot of monthly reports I get. But I know which ones are on bridge and I know which ones I should scrutinize more closely than the others in terms of risk.
Those investors, the limited partners that are sitting on the sidelines because of the unknowns and instability, is there anything that you do or say to them to try to convince them to invest when you have a deal, or is it really just about sticking to your game plan of being consistent and they'll invest when they're ready?
They'll invest when they're ready. There's no convincing. Again, like I said, a 50K is a very big investment. In fact, I had someone say that they wanted to invest in my deal that closed last year in October, but they were going to send a kid to college in 3 years and they wanted to know if this investment would close by then because all my three deals that have gone a full cycle so far have all been 27 months or less. And I said, I can't guarantee that. Plan for 5 years of illiquid. Don't plan to get your capital back in that time frame. And if you want it back sooner, then this is not the right investment for you. You should pick something more short term. And so, at least for me, I'm very direct and I'm very honest about the deals. And so I have one investor who's across 5 different deals in mine, and he wanted to know which one's the most risky. And I said, this is the biggest risk, and this is what I'm doing to try to mitigate it. And this is who I'm in touch with, which is basically my lender broker and my listing broker to know when that right time is to either refi or sell. So I'm always transparent. I know that I don't want to be pitched. I don't want to be talked into and pressured into investing in a deal. So I treat investors the way I want to be treated.
What's working with raising capital right now? Do you have any unique strategies or ideas to help people to raise more capital right now?
Understand your customers' pain points. Why do they want to do multifamily in the first place? Help them realize that money in the bank is definitely losing value on a daily basis. They're getting diluted. But do they have the nest egg they need? What is the reason for their fear? Are they afraid that 5 years from today, if they put their money into your building, your investment, is it going to be worth much less in 5 years or more versus the stock market? I mean, all of them, many of my investors at least, have their money automatically in the stock market from their W-2s, 401ks, etc. And it's gone through its cycles and waves. So I'm like, are you thinking that this building is now going to be worth more in 5 years based on this business plan? That's basically what I asked them. And then that's where you get into their heads. With some people, it's analysis. So you've got to understand your investor, the one you're talking to. With some others, it's just a basic fear, or their financial advisor told them. And I'm like, well, if all your money is in the stock market, that's not diversified. So make sure your financial advisor is aware of all the other investment classes you could be putting your money into, whether that's mobile home parks and self-storage, or gold and silver, or oil and gas, or currency, anything else, right? Is your financial advisor well versed in everything, or strictly the stock market? That's the question I ask. Who are you taking advice from, and what experience do they have for you to make these choices? So I just get them thinking, but I can't make decisions for them. That's up to them.
Sandhya, this has been a great wide-ranging discussion, from talking about active investing to passive investing, raising capital, your activity online. I've got a couple more questions that I think will bring a ton of value to people. Sandhya, what is the worst deal you've ever done?
My worst passive deal is one where I trusted the, unfortunately, social media hype of an operator with a strong construction background, and I invested passively in their deal back in 2019 when things were going well. I had money in my retirement account from my W-2. That's why I invest in so many deals passively. And then COVID hit in March of 2020. But from April to June 2020, rather than conserving capital, which is what we were doing in our active deals, they spent a lot of money that benefited their construction company. And then they had a capital call in July, which we all protested. Many of us were LPs. We knew each other. We protested it. And he changed it to a member loan. Now, I have to say that the deal, because of nagging pressure from me and some angry emails, they did end up selling it. And I broke even, and they made me money later of up to 10%. But it was quite stressful because of their mismanagement and misallocation of funds.
What's your takeaway from that?
So the biggest takeaway is watch those acquisition fees up front. If they have so much acquisition fee up front, it doesn't matter if they have any skin in the game, because once the deal closes, they got nothing left to lose in terms of actual money. The second one is if they have any affiliation like a construction company or anything else, that's going to make a huge amount of money anyway, regardless of how the deal performs. Then I don't feel like they feel the pain as much as I do. So after closing and after taking acquisition fee, do they still have money left in the deal is a question I ask.
Sandhya, what is one mindset tip, trick, or mantra that has helped to transform your investing?
It's all about changing states. If you surround yourself with negative people, that's all you're going to hear. If you surround yourself with people who have never done what you want to be doing, it's going to be very hard for you to find the ideas and creativity to go to that next level. So for me, I was surrounded by people who only had invested in the stock market. So I needed to go find a group where people did real estate so I can get my real estate up.
Great. Wise advice. Sandhya, if people want to connect with you, learn more about you, where would you like to send people?
LinkedIn is great. That's how you found me, or we found each other. My website is engineered-capital.com. So they can visit my website and connect with me there and download my checklist to vet a sponsor, etc.
Perfect. Those links will be in the show notes. Sandhya, I've really enjoyed this conversation. You've added a ton of value to myself and my listeners. Very grateful for the time you were able to spend with us today.
Thank you so much for the opportunity.
Great. All right, listeners, I hope you found value in today's conversation. If so, be sure to hit subscribe wherever you're listening or watching this. Reach out to either one of us if you'd like to connect. I appreciate you. Until next time, take care.